When we talk about preventing the next massive, like, global financial crisis, there is this dominant image we all seem to collectively share, you know?
Right, yeah, like a mental model of how safety works.
Exactly. It's the image of a dam. Think of a colossal, impenetrable concrete wall spanning this massive river valley, and regulators, like the central bankers of the world, they're standing right at the top of this wall.
Looking down at the rushing water.
Right. And the water represents global credit loans, the sheer flow of money, and they believe they have this iron fist. They really think that by constantly adding more concrete, by building the wall higher and thicker with more rules, they can perfectly hold back the floodwaters of excessive credit.
It is a very comforting image, honestly. The idea that if we just build the wall high enough
Yeah.
and watch the water level closely enough, we're all completely safe.
Because it feels binary.
Yeah, either the dam holds or it doesn't. And as long as the engineers, the regulators, are doing their math correctly, we should be totally fine.
But then you step away from the blueprints. You step into the actual, microscopic plumbing of the global financial system. You look at the data from the real world rather than just the textbook theories.
And that's when things get scary.
Because suddenly, that comforting image of the perfect concrete dam it completely shatters.
Yeah.
We are looking at a regulatory landscape where the regulators can do everything perfectly right. I mean, they can build the wall exactly to specification, and yet the tragedy still happens.
The flood still comes anyway.
Right, because the fire of the next bubble is already lit in channels they literally cannot even see.
It really is the absolute definition of a systemic blind spot. When the regulators are staring so intently at the top of the wall, making sure no water is spilling over, that they just completely miss what's happening right at the foundation.
The water doesn't break the dam.
No, it just relentlessly flows right underneath it.
Okay, let's unpack this. Welcome to our deep dive. Today, we are taking a massive stack of declassified regulatory data and an incredibly revealing academic paper, and we are going to extract the vital mechanics of how our financial system actually works.
And we really want to answer one fundamental question today.
The mission. Why does tightening the rules sometimes make the market go completely crazy?
Yeah. And we have the perfect source material to answer that. What's fascinating here is that we aren't just relying on theoretical models. We're looking at a paper published by the National Bureau of Economic Research, the NBER.
A very heavy-hitting institution?
Absolutely. And it's authored by 3 top-tier economic researchers. You have Shekhar Aiyar from the International Monetary Fund, Charles Calomiris from Columbia University, and Tomasz Wieladek from London Business School.
Okay, so a total dream team of economic hunters. What exactly did they do?
Well, they managed to get their hands on a secret regulatory database from the United Kingdom. And I mean secret. They tracked the UK's financial system from 1998 all the way to 2007.
Oh, wow. So right up to the absolute brink of the great financial crisis.
Exactly. It serves as the ultimate probe, really, into the anatomy of a financial leak. It is arguably the most pristine, perfect laboratory we have ever had in modern economics to watch what banks actually do like in real time when the regulator quietly turns the screws.
Because it just makes basic intuitive sense, right? Like you'd think that forcing big banks to hoard a bunch of cash during an economic boom will prevent a crisis.
Sure, that's the standard logic.
You force them to build up a massive safety cushion so that when things inevitably go bad, they don't collapse and take the whole economy down with them. But what this deep dive will show you is that relying on that logic alone is a fatal illusion.
A total illusion.
Regulators smashed banks with rules, but the credit keeps flowing anyway.
So, to understand why the dam breaks, we first have to look at how this specific dam in the UK was built. Because during this decade, from 98 to 2007, the UK wasn't just following standard global rules.
They were doing their own thing.
Very much so. They had constructed this secret, unprecedented regulatory laboratory.
Okay, let's set the stage for that. What were the standard global rules at the time? If I'm just a regular bank in the late 90s, what am I dealing with?
Well, to put this in context, most of the world at that time was operating under a global framework called Basel I. And Basel I was this sweeping international agreement that basically established a floor.
A baseline.
Right. It said, okay, every bank everywhere in the world needs to hold at least 8% of its risk-weighted assets as equity capital.
Okay, so let me make sure I have the math right. If I have, say, $100 million in risky loans out there in the real world, I need to have at least $8 million of my own money like shareholder equity sitting safely on the books to absorb any potential losses.
Precisely. It was a blanket rule, a one-size-fits-all minimum requirement designed to just create a baseline of global stability.
Like a national speed limit on a highway. Everyone drives 65 miles per hour. It's simple, it's public, everyone knows the rule.
Exactly. Yeah. But the UK's regulatory body, which was the Financial Services Authority, or the FSA, they decided that a flat 8% simply wasn't good enough for London.
Because London is a beast.
Right. It's this complex, hyper-competitive financial hub. So long before the rest of the world started talking about dynamic or macroprudential regulation.
Which is really just a fancy academic way of saying changing the rules based on the shifting economic weather, right?
Spot on. Before anyone else was doing that, the FSA was already running a massive experiment. They just threw out the blanket rule. Instead, they handed out completely personalized, constantly shifting minimum capital requirements to individual banks.
And this is where the first massive, anti-common sense slap really hits you. Imagine walking down a street in the London financial district. You have two banks side by side. Same city, same exact economy, same street.
Literally next door to each other.
Right. The regulator walks into Bank A and whispers, hey, you guys are fine. You only need to keep 8% of your money locked up. Then, that exact same regulator walks into Bank B right next door and says, you need to lock up a staggering 23%.
Yeah, a massive difference.
How does that even happen? How is a 15% difference justifiable on the same street?
It was an entirely discretionary system. The FSA created these personalized numbers, which they called trigger ratios. If a bank's capital fell below its specific secret trigger ratio, the regulator would intervene aggressively.
What could they do?
Oh, they could force management changes, halt dividend payments to shareholders, or even completely revoke their banking license.
So that's the iron fist.
That is the iron fist.
But how did they pick the numbers? Were they just pulling them out of a hat? Like, why 23%?
Not quite a hat, but it was highly subjective. The FSA adjusted these ratios based on a myriad of internal factors. So they looked at a bank's operational quirks, the quality of their internal management systems, their market focus, and the sheer concentration of their risk.
Okay, so if Bank B was heavily exposed to one specific, highly volatile sector, say, commercial real estate.
Right, or if the regulator just felt Bank B's internal auditing controls were a bit sloppy, the regulator would strike. Boom, your minimum capital requirement spikes from 10% to 15% overnight.
And the craziest part about this is the secrecy.
Absolutely wild. Nobody else in the market knew your number. It was a secret confidential communication directly from the FSA to the bank's board of directors. Bank A had absolutely no idea that Bank B was suddenly suffocating under a 23% requirement.
Okay, let me try an analogy here. It's like driving on a massive, chaotic highway where the speed limit constantly changes for every single driver. You look at your dashboard and you're told your speed limit is 40. The sports car passing you was privately told his limit is 80. The delivery truck behind you is told 25.
That's a great way to put it.
And none of you know each other's limits. You're just trying to navigate traffic without crashing into each other. It sounds like total chaos. How does a market even function efficiently like that?
Well, it creates immense friction for the individual banks, certainly. It's highly stressful for the management teams.
Yeah.
But if we connect this to the bigger picture, to the realm of economic research, that exact chaos is why this study is pure gold.
Because it creates a perfect testing environment.
Exactly. Think about how hard it is to study economics in the real world. In normal times, in normal countries, regulations change for everyone at the exact same time. So if the central bank raises capital requirements nationwide, and then total credit in the economy drops 6 months later, you have a massive causation problem. Did the credit drop because of the new regulation? Or did it drop because the whole economy just naturally slowed down and businesses stopped asking for loans?
You can't separate the two. They are entirely tangled up in the data.
Right. But the UK's secret shifting trigger ratios solve that problem beautifully. They isolate the exact microscopic moment a specific bank gets squeezed while its neighbor on the exact same street does not.
Oh, that's brilliant.
It allows these researchers to watch with surgical precision what that specifically squeezed bank does next, completely independent of the broader economy.
Okay, so let's put ourselves in the boardroom. The regulator knocks on the door, slides a confidential letter across the mahogany table, and demands the bank instantly increase its capital buffer. The individualized speed limit just dropped. What does a rational bank CEO do?
Well, the answer defies what most of us would consider basic logic.
Right, because when regulators say get safer and hold more equity capital, the general public and honestly, even many lawmakers, they assume the bank will just go out and get more equity.
That is the assumption, yes.
You assume they pick up the phone, call their investment bankers, and issue new shares of stock to the public to raise that required cash.
Because logically, if your required ratio is equity divided by total risky loans, and the regulator says the ratio needs to be higher.
The easiest way to fix the math is just make the top number bigger. Sell some shares, bring in $1 billion of fresh cash, boom, you're safer. The regulator is happy, and the bank gets to stay the exact same size.
But they don't do that.
They don't.
No. In the real world, the researchers found that banks almost never choose to issue new equity in response to a regulatory shock. Instead, they choose the nuclear option.
Which is?
Almost 100% of the time, they instantly, aggressively cut off loans to businesses.
Okay, here's where it gets really interesting. Why? Why on earth wouldn't they just sell stock? It seems so much easier than destroying your own loan portfolio and angering all your clients.
To understand this, we have to temporarily throw out the traditional academic textbooks. Specifically, a very famous concept called the Modigliani-Miller theorem.
Okay, let's unpack Modigliani-Miller. What is that, and why is it so wrong here?
Well, the Modigliani-Miller theorem is a foundational idea in corporate finance. In very simple terms, it argues that for a corporation, the way you fund your operations, whether you use debt, like borrowing money, or equity, like selling shares, doesn't actually change the fundamental value of the firm.
Give me a real-world example of how that's supposed to work.
Sure. Imagine you own a pizza shop. The shop generates $100,000 a year in steady profit. According to the theorem, it doesn't matter if you funded that pizza shop entirely with your own savings or if you took out a massive bank loan to open it.
Because people still buy the same amount of pizza.
Exactly. The underlying business still generates the exact same cash flow. Therefore, in a perfect world, a company should be able to seamlessly swap debt for equity without any real penalty.
It's an elegant theory, but I'm guessing the perfect world part is the catch.
A massive catch. The theorem strictly assumes a frictionless world. A world with no taxes, no bankruptcy costs, and most importantly, where everyone has perfect information.
And reality is...
The reality of banking is the exact opposite of a frictionless world. External equity going out into the market and issuing new stock is impossibly expensive for a bank. And it really comes down to two major real-world frictions: information asymmetry and tax structures.
Let's break those down step by step. Let's start with information asymmetry. Why does that make issuing stock an absolute nightmare for a bank CEO?
Think of it like selling a used car. The person selling the car always knows way more about its hidden flaws, the weird rattle in the engine, the leaky transmission, than the person buying it.
Right, the buyer's going in blind.
In economics, this is called the lemons problem. It was famously applied to corporate finance by researchers Stuart Myers and Nicholas Majleff. They called it the adverse selection problem of equity issuance.
So how does a multi-billion-dollar bank become a used car?
Well, a bank's balance sheet is arguably the most opaque, complicated financial document on Earth. It's not just a few simple assets. It's full of thousands of custom, complex loans to all sorts of businesses. And the bank's managers, the insiders, they know if those loans are starting to go bad long before the general public or the stock market ever does.
Okay, so let's run the scenario. I am a bank CEO. I get the secret letter from the FSA demanding more capital. I decide I'm going to do the logical thing and just issue stock. I announce to the world, hey, everyone, we're issuing 20 million new shares of our bank. What does the market actually hear?
The market hears total panic. Because the investors know you know more than they do, they instantly assume the worst possible reason. They think, uh-oh, the CEO knows something terrible that we don't. They assume your loan portfolio must be rotting from the inside out. They think you must be staring at a massive wave of defaults, and you are just desperate for a cash injection to survive before the whole thing collapses.
It's an automatic red flag.
Exactly. The very act of asking for external equity makes you look incredibly weak. Investors will punish you for it. Your stock price will plummet the very moment you announce the offering. They demand a massive discount to buy those new shares just to compensate for the risk that you're selling them a lemon.
It's a massive stigma. And here is the truly tragic part, right? Even if I, the CEO, am only issuing stock because the secret regulator explicitly forced me to do, the market doesn't know that.
Because the trigger ratios are completely secret.
Right. I can't even say, hey, guys, relax. The loans are fine. The FSA is just being strict this month. The market won't believe me. Or they just don't know the rules I'm playing under. So issuing stock is basically corporate suicide.
It destroys shareholder value almost instantly. So management naturally refuses to do it.
Huh?
But you also mentioned taxes. That's the second major friction.
Right. How do taxes make this even worse?
Well, the tax system in almost every developed country heavily favors debt over equity. If a bank pays interest on the deposits it takes in, or pays interest on bonds it issues, that interest payment is considered a business expense. It is completely tax deductible. It lowers their corporate tax bill.
But if they pay dividends to their shareholders...
Dividends are paid out of after-tax profits. There is no tax shield. So mathematically, equity is structurally, fundamentally, a way more expensive way to fund a bank than debt.
So let's look at the brutal math the CEO is facing. The regulator is standing there demanding a higher capital ratio. As we established, the ratio is simply your equity divided by your risk-weighted assets, which are mostly your loans.
Right.
The CEO looks at the top number, the equity, and realizes the market stigma and the tax penalty make raising it totally impossible. If you cannot increase the top number, mathematically, you only have one remaining choice to fix the ratio. You must violently shrink the bottom number.
You have to cut the loan.
You have to.
Precisely. You have to shed risk. You stop making new loans. You aggressively call in existing credit lines. You let current loans expire and just flat out refuse to renew them. You physically shrink the size of the bank to make your existing pool of equity mathematically large enough to satisfy the regulator's new percentage.
And this isn't just a theory, is it? The researchers actually measured exactly how violent this contraction is, and the numbers are shocking.
They are very stark.
The data shows that for every tiny 100 basis point increase in a bank's capital requirement, that is just a 1% bump, say the regulator moves you from 10% to 11%, that affected banks lending to the real economy suffers a cumulative collapse of 6.5 to 7.2%.
That is a staggering multiplier effect.
Yeah.
The regulator makes a seemingly slight, prudent tweak to the dial to ensure financial safety, and the bank's lending falls off an absolute cliff.
Think about the severe collateral damage of this. The regulator in London is looking at a spreadsheet. They are trying to discipline a massive financial institution. They want the bank to be safer, to have a thicker concrete wall in our dam analogy.
Right.
But the actual victim of this policy isn't the bank CEO. The CEO keeps their job. The actual victim is the local manufacturing factory whose vital credit line gets severed overnight without warning. It's the logistics company that suddenly can't finance its new fleet of trucks.
It's the real economy that pays the price.
It is a cold, brutal winter for the real economy. Everyday businesses are starved of capital because of a secret tweak to a regulatory formula.
This really destroys the academic illusion that regulation is a victimless, frictionless process. The friction is devastating. When the state forces safety onto the financial system through these blunt instruments, the real economy inevitably pays the price.
So we see the destruction, the local banks retreat, the businesses are bleeding, desperate for cash to make payroll, to buy inventories just to survive. You might look at this scenario and think, well, the regulators successfully cooled the market. It was painful, yes, but the credit boom is dead. The dam held. We prevented the bubble.
But nature abhors a vacuum.
It really does.
And so do global financial markets. When there's money to be made and demand is high, someone will step in. Enter the predators.
Right. While the UK's FSA is effectively strangling these local UK banks, forcing them to turn away desperate, paying businesses, an entirely different beast is prowling the streets of London, the foreign branch.
This is where the regulatory blind spot becomes the central protagonist of our story. We need to look at the legal structure of the London banking market at this specific time. According to the data, the UK FSA comprehensively regulated 104 local banks and foreign subsidiaries.
Okay, let's clarify that term for a second. What is a subsidiary?
A subsidiary is a legally distinct entity that is incorporated within the UK. So even if it's entirely owned by a massive American bank, the London subsidiary is legally a UK company. Therefore, the FSA has total jurisdiction over it. They control its capital requirements.
Okay, that makes sense.
But there was another group operating in London, 173 foreign branches.
Wait, 173? That's almost double the number of regulated banks.
Yes. And a branch is fundamentally different from a subsidiary under international law. A branch is not a separate legal entity. It is merely an outpost, an extension of a parent bank headquartered in Germany or the United States or Japan.
Ah.
And because of the way the cross-border legal frameworks were structured at the time, these 173 foreign branches held a golden ticket. They had special immunity. They were totally exempt from the UK FSA's dynamic, shifting capital rule.
Are you serious? Who were they answering to?
They only answered to the regulators in their distant home countries.
And what were those distant regulators demanding? Were they playing the same secret spreadsheet game?
Mostly no. They were just demanding the flat, static 8% Basel I minimum. There were no secret letters being slid across tables, no sudden, unpredictable spikes forcing them to 15 or 20%.
Oh my God, it's like putting a strict diet on half the kids in a school cafeteria. You tell the first half you're getting too hyper, no more pizza, no more soda, you're on a strict calorie count. But you give the other half the kids special diplomatic immunity, and they are allowed to stand right there in the exact same cafeteria and sell smuggled candy and pizza to the starving kids at a massive premium.
That's exactly what happened.
Of course the diet is going to fail. Overnight, this massive regulatory blind spot handed these foreign branches the power to launch a devastating asymmetrical strike against the local banks.
The regulators honestly thought they were putting out a fire. They thought they were draining the excess, dangerous liquidity from the domestic system. Instead, the foreign branches aggressively hijacked the clients.
And how did they do it? Did they just stand on the street corner handing out cash to anyone who asked? Because that sounds pretty risky for the foreign branches too, right?
Yeah, no, it wasn't random at all. It was a highly calculated precision strike. The researchers mapped this out beautifully in the data. The foreign branches relied heavily on something economists call soft information.
What is soft information in banking?
Banking, especially corporate lending, is not just about reading a balance sheet. It relies heavily on long-term relationships. It's about knowing the management team personally, understanding the specific unwritten quirks of a niche industry, knowing which clients are trustworthy, even if their current quarter looks slightly weak on paper. That is soft information. It's qualitative.
So how did the foreign branches use this to their advantage?
The foreign branches didn't just guess who to lend to. They specifically targeted niche industries where they already had a significant foothold. In some specific sectors of the UK economy, these unregulated branches already controlled over 40% of the market share.
Wow, so they were already massive players in certain niches.
Exactly. So when the local regulated banks were forced by the FSA to suddenly retreat and cut credit lines, the foreign branches didn't have to onboard strangers. They simply opened their spigots wider for the clients and industries they already deeply understood.
They just absorbed the market share of their competitors who literally had their hands tied behind their backs by the government. So, did the researchers calculate exactly how much of the regulator's effort was just totally wasted?
Yes, and the math is incredibly precise. The researchers calculated the exact volume of the leak, almost 1/3. Precisely 29.4% of the entire credit gap created by the regulators was instantly filled by these unregulated foreign branches.
Think about that. The regulator forces a local bank to cut a vital loan by $10 million. The regulator pats themselves on the back, thinking they've removed $10 million of risk from the system. But the very next day, a foreign branch down the street steps in and loans that same business roughly $3 million. The policy leaked like a sieve.
It was a highly targeted, ruthless arbitrage of the rules. Arbitrage is a term usually used in trading. It means taking advantage of a price difference between two identical assets in different markets. But here, the difference wasn't the price of an asset. It was the cost of regulation.
That's fascinating.
The foreign branches had a structurally lower regulatory cost, so they relentlessly exploited the gap left by the constrained domestic banks.
Now, if I'm listening to this, I might be playing devil's advocate for a second. A skeptic might say, wait a minute, you guys are making a huge assumption here. How do you know the foreign branches were actively stealing the business because of the regulation?
It's a fair question.
Maybe the UK economy was just naturally slowing down at the exact same time. Maybe businesses just stopped wanting loans because the market was cooling off. You're assuming it's a supply-side leak, but what if it's just a drop in demand?
It is the absolute classic causation versus correlation problem in economics. Did the lending drop because the bank was unfairly squeezed by the regulator? Or did the lending drop because the borrower simply didn't want the money anymore?
Right.
It's a very fair critique.
That's correct.
But the researchers anticipated this exact counter-argument. And the way they proved it uncovers a bizarre psychological paradox inside the banks themselves.
Let's talk about the paradox of the safe bank, because this is another massive anti-common sense slap. Let's use our driving analogy again. Common sense dictates that if you are already driving 40 miles per hour and the speed limit drops from 65 to 55, you don't slam on the brakes, right?
No, why would you?
Because you're already safely below the limit. You just keep doing what you're doing.
Right. So applied to banking, if a bank is sitting on a massive mountain of extra cash, a huge capital buffer way above what the regulator requires, you would assume they wouldn't panic when the rules tighten slightly. If the FSA says your minimum is now 10%, but you are sitting on 15% equity, you should just shrug and keep lending.
But what did the data actually show?
The exact opposite. The safest banks, the ones with the fattest, most robust capital buffers, actually slashed their lending the hardest and the fastest when the regulator raised their minimum requirement.
Wait, why? That makes absolutely zero logical sense. If you have the money, why crash your loan portfolio?
Because you have to look beyond the spreadsheet and look at who these high buffer banks actually are in the real world. They're usually much smaller players. They aren't the giant multinational mega banks with direct pipelines to Wall Street.
Okay.
They are smaller, regional, or highly specialized institutions that are deeply, deeply terrified of the capital markets.
Terrified why?
Because they know, better than anyone, that they cannot raise external equity easily if they get into trouble. They suffer from that lemons problem we talked about earlier, even more intensely, because they're less known to public investors.
Right. They don't have the brand name trust.
Exactly. So they hoard cash defensively. They hold massive buffers, almost out of institutional paranoia.
So that massive 15% buffer isn't a sign of unshakable strength. It's a psychological security blanket.
Exactly. They intentionally hold that extra 5% above the legal minimum because that is what they need to sleep at night. When the regulator cracks the whip and raises their minimum requirement by just 1%, their precious security blanket just shrank.
The gap between their actual capital and the legal cliff edge got smaller.
Yes. So they don't look at it mathematically and say, oh, well, we still have a comfortable 4% buffer.
No, they panicked.
They hyperventilate, they sound the alarm, they say red alert, the gap is closing, rebuild the buffer at all costs. And because we already know, they won't issue stock.
Because of the stigma and taxes.
Right. They brutally sever credit lines to the real economy to restore that specific psychological cushion they feel they need to survive.
Put yourself in the shoes of that small bank CEO. You have plenty of cash, more than enough to legally cover the new rule. But you are so absolutely terrified of the regulator and so deeply terrified of the unpredictable nature of the market that you voluntarily crash your own business.
It's wild.
You destroy your own long-standing lending relationships just to look hyper-compliant and maintain your paranoia-induced cushion. It's wild. Human psychology completely overrides mathematical buffers.
This raises an incredibly important question about the limits of mathematical regulation. Regulators can build all the dynamic capital buffers they want into a pristine spreadsheet. But if they don't account for the paranoid, defensive psychology of human bank managers, their policy will wildly misfire.
But wait, we still have to answer our skeptic. The paradox proves banks panic, but it doesn't fundamentally prove that customer demand didn't drop. How do we know, for an absolute scientific fact, that businesses didn't just stop borrowing? How did the researchers rule out the illusion of a demand drop?
This brings us to the hardcore methodological backbone of the NBER paper. To get this published, the researchers had to engineer a brilliant, highly sophisticated metric to completely isolate and strip away the demand excuse.
They created an irrefutable mathematical loop. Explain how they did it, and let's try to do it without getting bogged down in statistical jargon.
Sure, think of it like a clinical medical trial where you need a perfect control group to prove a drug works. In economics, finding a control group is notoriously hard. Let's say Bank A gets hit with a strict letter from the FSA, raising its capital requirement. Bank A immediately cuts its lending to the UK manufacturing sector.
And our skeptic says the manufacturing sector's just dying. They don't want loans anyway.
Right. So how do we prove the factory still wanted the money? The researchers looked at other banks, specifically the unregulated foreign branches, or even domestic banks that didn't get a strict letter from the FSA that particular quarter.
The lucky ones.
Exactly. They looked at these control group banks who were also actively lending to that exact same manufacturing sector at the exact same time.
Okay, let me trace the logic here. If the manufacturing sector was truly dying and factories genuinely didn't want to expand or borrow money, then all the banks, regulated or unregulated, would see a simultaneous drop in their loans to that sector.
Right. Correct. The demand drop would affect everyone equally. But that is not what happened. In statistics, the researchers used these unregulated banks as an instrumental variable, sometimes called a Z variable. It acted as a pure proxy for demand.
And what did it show?
It proved that while the regulated Bank A was aggressively cutting loans to manufacturing, the unregulated foreign branches were happily increasing their loans to the exact same factories.
Wow. The demand was absolutely still there. The factories were practically begging for cash. The only thing that changed was the supply from the regulated bank.
Exactly. And to make the proof utterly bulletproof, they ran all of this data through a complex statistical model called a panel vector autoregression, or a panel VAR.
Vector autoregression. That sounds like a sci-fi weapon. What does it actually do in this context?
In economics, you always have the problem of endogeneity, which is really just a fancy way of asking what caused what. Did the regulator tighten the rules because they saw loans were starting to go bad? Or did the loans go bad because the regulator tightened the rules?
Right, chicken and egg.
A VAR model solves this by mapping out the dynamic chain reaction relationships between variables over time. It's like throwing a stone into a pond and mathematically tracking the ripples period by period.
So it maps out the timeline to prove causality.
Yes. They tested the sequence of events. Did total lending drop before the rule change? No. Did the regulator change the rules in response to a drop? No. The VAR model proved that the regulator's action was an independent, exogenous shock.
The stone hitting the water.
Exactly. The regulator dropped the hammer, and only after that hammer fell did the loans violently drop. Tighter rules caused the leak, period. The causality is as bulletproof as it gets in economics. The action of the regulator directly forced the contraction of the local bank, which directly created the vacuum that the unregulated foreign branch filled.
So, what does this all mean? We've spent this time looking at the microscopic mechanics in London. We've looked at the secret letters, the boardroom panic, the CEO's fear of the stock market, and the foreign branches swooping in to steal the clients. Now, let's zoom out. What does this mean for the entire world? Because this isn't just a story about London in 2002.
No, not at all. It leads us to a much broader macro tragedy. We have to fundamentally change how we view capital. We have to understand that global capital is a living, breathing entity.
It's not just numbers on a page.
It isn't static. It doesn't just sit there waiting to be told what to do. When a nation tries to forge an iron wall of financial safety around its domestic banks, it isn't actually destroying risk. It is merely evicting it.
Evicting it. I love that phrase. It's forcing high-yield, high-risk economic activity to flee the sunlight. You kick the risky loans out of the well-lit, highly monitored, highly regulated domestic banking sector, and it mutates in the shadows. We are fracturing our own financial world. We are building a fortress to feel safe, but we are essentially locking the monsters outside with all the innocent civilians, the real-world businesses that just need a loan to survive.
Exactly. And to be fair, international regulators eventually woke up to this fatal flaw. This paper, and others like it, forced a reckoning. When the regulators got together to write the next generation of rules, Basel III, they recognized the leak. So they introduced a new concept to try and plug the hole. They called it the reciprocity principle.
The reciprocity principle, it sounds like a global peace treaty. What does it actually do?
It's an agreement that attempts to force foreign branches to play by local rules. Under reciprocity, if the UK regulator says the countercyclical capital buffer needs to go up because the London market is getting too hot, then the French, American, and Japanese branches operating in London have to honor that specific UK rule for their UK-based loans.
Oh, instead of just using their home country's flat rule.
Exactly.
So it's an attempt to eliminate that 30% arbitrage leak the NBER paper discovered. It levels the playing field.
That is the intention, yes.
But does it actually work? I mean, it might successfully stop a regulated foreign branch from undercutting a local bank. But here's the ultimate slap in the face. It does absolutely nothing to stop the infinite evolving swarm of shadow banks.
If we connect this to the bigger picture, it reveals the eternal game between regulators and markets. Capital follows an ultimate, undeniable physics. Just as water flows relentlessly to the lowest ground, capital flows with gravitational certainty to the darkest, most deregulated corners of the earth.
Because risk and return are inseparable. If there is demand for a loan, someone will find a way to fund it.
Always. Any slight difference in rules anywhere in the ecosystem creates a flood. If you use the reciprocity principle to block the foreign branches, the water just finds the shadow banks. If you block the traditional hedge funds, it finds decentralized finance and crypto markets.
It highlights the sheer futility of playing whack-a-mole with trillions of dollars. You hit one legal loophole with a regulatory hammer, and the money just instantly teleports to a new, darker hole that you haven't even written a law for yet.
It can feel futile.
Yeah.
But understanding this physics of capital is not a reason to give up on regulation. It is the only way to avoid being completely blindsided by the next crisis. You can't just keep trying to build a taller, thicker concrete dam. You have to understand the nature of the water itself. You have to regulate the activity of lending, not just a specific legal entity that happens to have the word bank on its front door.
Which brings us back to the journey we've just taken. We've seen how the very tools meant to save us, the strict capital requirements, the iron fist of the regulator, the well-intentioned safety buffers, actually fueled a massive shadow boom in the UK right before the greatest financial collapse of our generation.
The policy, despite all its mathematical rigor and good intentions, acted as a catalyst for risk to migrate precisely into the blind spots.
And now, I want to leave you with a thought to mull over as you look at the news today. Look at the financial world right now. Regulators routinely boast that global capital requirements are more perfect, more dynamic, and more ironclad than at any point in human history.
They point to the stress tests constantly.
Right. They tell us the banks are safe, interest rates have spiked, the speed limits have been changed, and the banks haven't collapsed.
And to their credit, the regulated banking system does, on paper, look safer than ever. The visible buffers are massive.
But wait, look outside the fortress. Look where the water is flowing. Shadow banking is expanding at a scale that is unprecedented and entirely unregulated. Private credit markets are exploding, lending trillions to corporations outside the view of the central banks. Decentralized finance and digital dark pools are surging.
The water is finding the lowest ground faster and more efficiently than it ever did in 1998. The technology of evasion has evolved.
So, consider this chilling, provocative thought. Are we just staring at a new, high-tech version of the exact same 1998 London script? The dam looks magnificent, the concrete is pristine, but are we perfectly, flawlessly regulating the banks we can see, while the exact same water is quietly gathering in the dark? Is the next global financial meltdown already fully funded by the shadow predators we aren't even looking at? Keep your eyes on the shadows. Until next time.